In our last video, I taught you how inflation can turn real estate investors and entrepreneurs wealthy. And in this video, I'm going to take it a layer deeper. I'm going to introduce you to a concept called inflation-induced debt destruction. And don't let that name overwhelm you. I'm simply going to show you how inflation destroys debt, and it'll help you on your journey to understand how the money system works and how you can use inflation to your advantage rather than being a victim of inflation. So let's kick off this lesson with a quote from Adam Smith from the 17th century. And Adam Smith said, "The problem with fiat money is that it rewards the minority that can handle money, but fools the generation that has worked and saved money." And what he means by that is the fiat system rewards those that are investors and it punishes those that are savers. And what he meant by savers was literally hiding money under the mattress, or literally hiding those fiat dollars under the tree in the backyard. Now, just to make sure everybody's following me, let's make sure we define what fiat money is. Fiat money is a government-issued currency that is not backed by a physical commodity such as gold or silver, but rather the government that issued it. The full faith and trust of the US government. Of course, our dollar is good, except in 1971, President Richard Nixon took us off the gold standard. No longer was our dollars convertible for gold, and at that moment, the US dollar became a full fiat dollar, only backed by the credit and faith of the US government. And let's see how that worked out for us. In 1971, you could buy a new house for $25,000. You could send your kid to Harvard University for $2,600 a year, and you could buy eggs for 47 cents a dozen. Obviously, the buying power of the US dollar has been greatly diminished since we became a fiat money, and that is exactly what Adam Smith warned about in the 17th century. Let's look at cumulative inflation since 1913, which happens to be the year that the Federal Reserve was formed. So from 1913 to 1970, a period of 57 years, we had 284% inflation. If you think about that, that's roughly 60 years. You had 300% inflation, which means every 20 years, a 5-cent piece of gum doubles to 10 cents. Over 20 years, if a piece of gum goes from 5 cents to 10 cents, it's not that big of a deal. It is controllable inflation. But look what happened right about 1971 when we exited the gold standard. We've had a run-up of approximately 2,800% of inflation between 1970 and today, 2025. Let's call that a period of 55 years. So think about that for a moment. We saw 284% inflation in a period of 57 years, and we've seen about 2,800% inflation in a period of 55 years, over the last 55 years. That means the last 55 years since becoming a fiat currency, we've seen 10 times the amount of inflation as we saw in the previous 57 years. That's a problem. So if you're a saver, you're going to get punished. If you're an investor that understands inflation, you're going to get rewarded. And by the way, guys, I don't love this system. I would love to go back to the pre-1971 system, but I don't make those rules. So my job as an investor, whether I like the system or don't like the system, is to know how to game the system. My job is to figure out how to win inside the current system that we have, and that's what I'm here to help you do as well. And that brings me to inflation-induced debt destruction. Now, I need to give credit where credit is due. This was a concept taught to me by Jason Hartman, And you can learn more at jasonhartman.com. He enabled me or gave me approval to teach this concept, at least as long as I give him credit for the great work that he did. Now, this is a case study of a mortgage loan to teach you inflation-induced debt destruction. And this is an actual case study. As I remember the story from Jason, this was the actual story of his mom's home loan over 30 years. And we use this to demonstrate the inflation-induced debt destruction. So let me get started and walk you through this. What we have here is a home value in 1972 of $18,000. The mortgage amount was $14,000. The mortgage interest rate, 7.37%, and the mortgage term was 30 years. The monthly payments was $100 a month, and we'll assume an assumed tax rate of 33% a month, which is very important. What we've done here is shown an amortization chart of sorts, showing the year from 1972 for 30 years until the loan was paid off in 2001. Then we've charted the annual inflation rate, and team, we only used the CPI rate, which is really a manicured and edited version of inflation. So these inflation numbers are likely a lot less than the actual inflation in the economy, but this is the number that the government used, and this is what we're going to use. So we charted the annual inflation rate for each year. Well, by definition, if there's inflation, then the dollar is being devalued. The buying power is less. You're seeing currency debasement. So in this column, we are showing you each year as we go on in time, the value of the dollar gets less and less and less. So in other words, $1 in 1972 saved under your pillow until 2001 only has 23 cents in buying power. You've lost over 76% of the buying power of that dollar over a 30-year period of time. Well, if the buying power of the dollar has gone down by 76%, then doesn't it make sense the value of the debt that is denominated in dollars has also gone down 76%? So in this column, we show you your nominal payments. Nominal means name alone. So in name alone or nominal terms, the mortgage payment was $1,210 per year, $100 a month, over 30 years. That's how many dollars left the checking account. But once you adjust for inflation, the number of dollars leaving the checking account actually went down each year. And that's the difference between nominal, name alone, and real, which means inflation adjusted. So if we look at the annual inflation adjusted payments, they were quite a bit less and decreasing each year as inflation debased the value of the US dollar. And then we've added a final column, which is the annual after-tax inflation adjusted payments. So adjusted for inflation and adjusted for tax. And we've done that year by year over 30 years. So what's the punchline? In nominal payments alone, the payments on this mortgage over 30 years was $36,000. But once you adjust for inflation, the debasement of the dollar year by year, your real payments were only $16,000. In other words, it felt like you only made $16,000 in repayments because inflation was driving up wages. Of course, it drives up rental income if you had rental income in this property. And of course, it drives up your value of your property. So all of those things are moving up while your payment stays the same. So the real or inflation adjusted dollars, only $16,000. And then once we adjust for taxes as well, only $12,000 in repayment. So many of you may be asking about this column. Well, what do you mean they actually paid $1,200 a year, but it feels like they're making less and less payments every year as time goes on? Well, let's explain that a little bit deeper. This is what happened to median personal income in the United States from 1972 to 2001. This isn't household income. This is personal income for one person. And you can see when we started this journey back in 1972, the median personal income was $4,600 a year. Fast forward over 30 years in 2001, the median income was $21,000, almost $22,000 a year. So if we break this down into monthly terms, the mortgage payment was $100 a month, and the borrower was bringing in roughly $400 per month. So 25% of their income was going to pay the $100 a month mortgage payment. Following me so far? Then over time, inflation drove wages up so that now you have about $22,000 in annual income, but you're still, so if you break that down monthly, what are we, $1,800 a month, something like that, $1,700 a month, something like that, but you're only paying $100 a month for your mortgage. So inflation destroys debt, and it feels like you're making less payments over time because inflation has pushed up real wages and inflation has pushed up rental income if you have a rental property. So let's summarize this whole thing to see how spectacular inflation-induced debt destruction can be. So the original mortgage size was $14,614. In nominal terms, they repaid $36,000 at a rate of 7.37. But in real inflation-adjusted dollars, they only repaid $16,000, and the inflation-adjusted interest rate or cost was 1.06%. And then after you normalize or factor in tax deductibility as well, the after-tax inflation-adjusted dollars to repay was $12,655, which is less than the original mortgage size, which means the after-tax inflated adjusted interest rate was negative 1.16%. That's why I say inflation makes intelligent investors rich, and it makes savers poor. This is what it would have felt like to make those mortgage payments over a 30-year period of time. As inflation debased the currency and wages went up, and this is annual, by the way, the feeling of making the payment goes down over time. Now, this was an example of a primary residence and somebody's wages going up and wages destroying debt. But what if it was an investment property? This is an actual property that I own. I purchased it in 2001, so I've owned it for 24 years. I bought it at $315,000. The monthly income is $300 per month. I have annual income of $28,800 because it's an 8-plex. So I have 8 units here, $300 a month, $2,400 a month times 12. This is my annual income. My mortgage payment, I 100% financed this property from the seller on a seller note at 7% interest. My mortgage payment was $2,096 a month. Remember, my monthly income was $2,400. This was negative cash flow for the first 5 years. I wouldn't recommend this to anybody, this deal. But it turned out okay because of inflation. If we fast forward to today, I'm pulling in $12,000 a month in rent, $480 in other income for $12,650 per month in income. And remember, my mortgage payment stayed the same. So when I'm bringing in $2,400 a month in income, and my mortgage payment's $2,000, I'm at like a 90% debt to income ratio on this deal. Fast forward 24 years, I'm bringing in $12,000, almost $13,000 worth of income. My mortgage payment's still $2,000 a month, and the percentage of my income that's going to pay that mortgage has gone down. That's just another example of how inflation destroys debt. Once you understand this principle, you'll never pay off a mortgage early again. You'll take those savings, you'll invest it in another asset and go grow another asset. I hope this was informative. I hope it was insightful, and I hope you will use this as leverage to accelerate your real estate journey.